friends, and welcome to Looking at the Markets with David Modell. I'm going to tell you about a couple of covered calls options strategies. I'm going to give you a basic one, and then I'll give you a slight variation upon it, all right? What's great about covered calls is that most brokers will probably give you permission to sell a covered call after you buy 100 shares of a stock or ETF or whatever. That's usually the basic level 1 options permission level. Okay, so if you just ask your broker to apply for selling covered calls, usually they'll let you do it. Not always, but it's worth a shot because it's a great way to get some extra income when you buy 100 shares of a stock or ETF. Because did you know that 80% of the time, 8 out of 10 times, statistically speaking, those options are overpriced. All options, just on average, options are overpriced. So if you buy 100 shares of a stock and then sell a covered call, especially an at-the-money covered call, the stock probably won't move that much, or it won't have moved up that much upon expiration compared to the payment you received, the premium payment. All right, so whatever premium payment you received, the stock probably won't even move that much, and so 8 out of 10 times you'll be glad that you sold that covered call. Now maybe 20% of the time, you'll buy 100 shares of stock, sell a covered call, and then the stock price will just shoot up to the moon, and above and beyond the premium payment you got paid for selling the covered call. And then you might regret selling that covered call. Let's say 20% of the time, but 80% of the time it won't even move that much. So first, let me explain what kind of covered call I usually might sell. Usually it'll be at the money. So let's say this is the price at which you purchased 100 shares of stock or ETF or whatever, right? So this is the at the money strike price right here. All right. And then this would be out of the money, okay, above, with the strike price above where you bought the 100 shares of stock. And this would be this is an out of the money covered call. All right, and this would be an in-the-money covered call, meaning below. The strike price is below the price at which you bought the 100 shares of stock. All right, I will usually want to sell an at-the-money covered call, right at the strike price being right at the same price or close to it at which I bought the 100 shares of stock, because you get the most bang for your buck, usually. When you sell an out-of-the-money covered call up here, you just don't get paid much. Your premium payment is usually pretty small. So yes, you get to enjoy the upside potential movement of the 100 shares of stock, but as far as the premium payment itself, it's usually pretty paltry. It's pretty small. And now when you sell an in-the-money covered call, you'll get a nice fat big premium payment up front, but then when it's time for you to sell your 100 shares of stock, you're selling way down here. You're selling at a very unfavorable price. And so you get a big fat premium payment up front, but then you end up losing a bunch of money when you have to sell your stock share. You bought your stock shares here and you have to sell them down here. That's no fun. So your net payment usually ends up being not very favorable, okay? So yes, your gross payment, your upfront premium payment is bigger when you sell an in-the-money covered call, but usually net, you don't get as much bang for your buck. So as far as net, payment is concerned, an at-the-money covered call is usually you get a nice fat payment in terms of net payment. All right. And also at-the-money covered calls oftentimes get some really good theta decay also. Now out of the money options have really good theta decay, but at the money options have pretty good theta decay as well. In the money options oftentimes do not have really good theta decay on them. They just they don't decay as much as you'd like to, because you're a seller of that call and you want it to deteriorate after you sell it as much as possible. All right, so what about the expiration date? Well, a lot of options experts will recommend selling 45 days out, okay, until expiration, or at least somewhere between 30 and 60 days out till expiration. But as close to 45 days as possible is oftentimes recommended. You don't have to do that. It really depends on how long you want to, what your time horizon is. Maybe you don't have that much time, or maybe you want to think further out in time. So it's really up to you. But I think if you want, in terms of time, the most bang for your buck, I really like to get as close to 45 days out as possible. You get some really good theta or time decay that way, and you get a decent payment. All right. So to really get the most bang for your buck, I recommend selling an at-the-money covered call and go as close to 45 days out as possible. And when I say try it, you want to virtual or demo trade everything first before you commit any real capital to it. You want to try it out. Test it for yourself. Don't do anything just because I like it. All right. So that's probably the simplest covered call strategy that I can think of, which is just buy 100 shares and then immediately sell an at-the-money covered call 45 days out. Simple as that, all right, or as close to 45 days as possible. So, and again, 80% of the time, it won't even move as much as you got paid for it, all right. So a variation on that, and I'm going to try to draw here, and oh boy, here we go. My drawing skills are really interesting, all right. But okay, so let's say you've got a stock, right? And here's the stock price. It kind of it goes wherever it goes down, and then it starts to come back up. My drawing skills are terrible, right? And it starts to come back up, right? Okay, great. And then it's here, and then you buy 100 shares, right? Fantastic. And then you sell. You could sell an at-the-money covered call right then and there. That's the first strategy, and that's fine. You're probably not going to get a ton of money, though, for your premium payment. You'll get some money, but not a whole lot. What you can do instead is buy your 100 shares right there, and then wait until the stock goes up, and then sell your covered call, okay? Because the stock has gone up a lot now. And what do you think happens to the covered call price when the stock just goes up and up and up and up? Man, you're going to get a nice fat premium payment, okay? So at the money is now here, right? Okay, your buy price for the 100 shares is down here. But you're now selling an at the money covered call, but at a higher price than where you bought it, where you bought the 100 shares of stock or ETF, okay? You're going to get a nice fat premium payment because options traders are really willing to pay a lot for those calls now. So yeah, you'll get a decent payment here, but you'll get an even bigger payment here, and so you might want to consider that. Maybe test that out. Test this strategy out with demo trading or virtual trading and see if you like it better, okay? It takes a certain amount of patience to do that. Because it's very tempting. First of all, if you didn't sell a covered call here, you just bought here, and now the stock's up here, it's very tempting just to sell your 100 shares of stock for a nice profit, all right? From here to here, you profited just on the stock price rising. But if you have patience, if you don't mind waiting longer to sell, then you can get a nice fat premium payment if you sell an at-the-money covered call up here. And also think about it. How much higher is the stock likely to go now? Probably not much higher. It's probably exhausted by this point. If it's gone up and up and up and up, it could go a lot higher, but what's the likelihood? We're talking about probabilities, not possibilities. Yeah, it's possible it'll go up a lot more, but usually it gets to the exhaustion point, or at least a consolidation kind of point where it just goes sideways, whatever, chops around. As they say, trees don't grow straight to heaven. All right, so usually stocks just don't keep going up forever. Probably always stocks don't just go up forever. I don't think I've seen one that does. Maybe there's one out there. I don't know. But usually it takes a breather. And so you can really enjoy the time decay here if you sell a covered call right here. You get a nice fat premium payment, and probably the stock won't go up much more. So that's a pretty good place to sell that covered call on your 100 shares of stock. All right. But again, it takes discipline and patience not to just take the money on your 100 shares and run here. And there's nothing wrong with doing that. You don't have to sell a covered call here if you don't want to. But it's an alternative to just selling it at the time when you bought the 100 shares. All right. These are both valid strategies. They have pros and cons. So I recommend testing them both out with virtual trading, demo trading, before you commit any capital. Keep your position sizes small. Be careful. Don't do anything because I like it. Do it because you researched it and tested it out thoroughly and decided that you're willing to take that risk. All right. Hey, if you like this, hey, why not give me a thumbs up, all right? That encourages me to make more videos. Maybe you like these options videos, and so that'll really encourage me. And please subscribe to my YouTube channel and hit that notification bell right now so you can get updated whenever I put out videos like this one. So thanks a lot. I appreciate it, and I'll talk to you again soon.